Hi, the Ordinary Investor welcomes you to today's video, and today we'll look together at an analysis of KLA stock. This company is key for the production of memory and chips, and we'll take a look at it together today. So sit back comfortably and enjoy the video. I'd also like to mention that this video is not investment advice, and you should consult everything with a financial advisor first. But before we start, let's first get to know this company. KLA is one of the most important players in the semiconductor industry, even though most investors don't know it. The company doesn't actually design or even manufacture chips. Instead, it supplies technologies that control the quality of their production. You can imagine it like quality control in a car factory. This company constantly checks during production if everything is made perfectly accurately and can detect even microscopic errors that could cause the final chip to malfunction. And thanks to that, manufacturers can fix errors before they lose a huge amount of time and, most importantly, money. Their largest customers include companies like TSMC, Samsung, Intel, Micron, or SK Hynix. And so I think that everyone who invests in the semiconductor industry should know this company, because without technologies from KLA, the production of the most modern chips would be significantly more expensive, more complex, and at the same time, many more defective chips would be created. And that's why the importance of this company has grown significantly in recent years, mainly thanks to artificial intelligence. And it's no surprise that the company has built a dominant position in this market. As we can see on this chart, this company currently controls approximately 58% of the entire global market. And so it's no wonder that the company exceeded analysts' expectations in the last quarter, both in earnings per share and in revenue. The company beat earnings per share by about 3% and revenue by 1%, and KLA has already gained more than 50% since its last quarterly results. What's great about this company are the margins, where the gross margin is at 62% and the operating margin is at an incredible 43%, and we see that the margins are constantly improving. On this slide, we see exactly where the revenue comes from. The vast majority of revenue, 90%, is made up of the semiconductor process control segment, which are the technologies for quality control during chip production. And revenue in this segment grew at a year-over-year rate of 13%. And on the right side of the slide, we see where the demand comes from. Approximately 62% of revenue comes from chip manufacturers such as TSMC, Samsung, or Intel, and 38% is made up of memory manufacturers, which include Micron or SK Hynix. And I like that, because the company isn't dependent on just one type of customer, but benefits from the overall growth of artificial intelligence. And let's look further at the financials, because those are absolutely exemplary in my opinion. The earnings payout ratio is decreasing nicely, and we should be below 50%, which we are. And it means the company will have more and more money left to potentially increase dividends. Let's move on and look at earnings per share, which is growing at an exemplary rate. And that pace is expected to keep accelerating from about 19% to 29% in the next 12 months. Looking further at revenues, they're growing at impressive double-digit rates. Regarding share buybacks, we see the company has repurchased about 250 million shares over the last 10 years, which is great news as it increases the value of individual shares. Looking at the company's debt, it's not increasing at all, which is another positive sign, and we can also see this in the net debt to EBITDA ratio. This indicates how many years it would take for the company to pay off all its debts and liabilities. We should be under 1.5 years, and we're currently at 0.21. This means it will take the firm about 2 months to pay off all its debts and liabilities, which is very positive, and that value continues to decrease. So the company looks very, very attractive. But the question is, isn't it already too expensive? Let's find out together, starting with something you know well, the blue tunnel chart, which shows where the stock price should ideally be. Right now, we can see we're extremely high above this blue tunnel, which indicates that the company is significantly overvalued. If we zoom in, we can see it in even greater detail. We can also see this in the forward PE ratio, which is at 62.7, while the 5-year average is 22.5. And that's another sign that the company is overvalued. So it's no surprise that, according to 32 of the world's largest investment banks, the company is overvalued by about 27%. Just for interest, the PEG ratio is even at 3.4, which is yet another sign of the company's overvaluation. What I also find very interesting are the Wall Street analyst estimates, who expect a drop in the target price even in the most optimistic scenario by about 25%. According to the realistic growth scenario, the stock is overvalued by about 40%. KLA is truly a great company. Its debt level is low and it's a healthily growing company. Margins are very strong and the return on capital is excellent. The problem, however, is the valuation, as the company is really expensive. Now let's calculate the fair value using our favorite DCF model with 3 growth scenarios: pessimistic at 15%, realistic at 20%, and optimistic at 25%. Let's start with the most pessimistic scenario, which is 15% growth. This gives us a fair value of $127, which is 54% overvalued compared to the current market price. This means that we are at level 5 and the stock is very expensive and very risky to buy. Let's move on and take a look at our realistic growth scenario, which is 20% growth. Here, the fair value of the stock came out to $171, which is a 38% overvaluation compared to the current market value. We are back at level 5, and that means the stock is indeed very expensive. Let's move on and look at the most optimistic growth scenario, which is 25% growth. Here, the fair value of the stock came out to $230, which is a 17% overvaluation compared to the current market value. We are at level 4, which means the stock is overvalued, or it's a possible overvaluation of the stock. However, to be as conservative as possible, we'll use our realistic growth scenario of 20%, and I'd expect a fair value of $171. And we were trading around those fair value levels quite recently, specifically in May of this year. And so we are now approaching the end of the video. I'd be interested to know who among you knows this company and if you have it in your portfolio. If you liked the video, I'd certainly appreciate it if you'd leave a like and subscribe to this channel. Feel free to also let me know in the comments which other company you'd be interested in for the next video, and maybe next time luck will smile on you. That's really all for today's video. Thank you all so much for your attention, but especially for your support. Take care, bye.